What's going on, everyone in Big Block? Very happy to have Jason Cota here from Fairway Mortgage. We're going to have a great chat on second homes and how you can finance them, how you can help your clients get into better deals. And I guess a great place to start, I think, was you were just telling me that you just bought a second home. So why don't you kind of just tell me about that, and then we can get into all the other financing stuff.
Sure. Yeah. So I had kind of considered for a while was I was doing a lot of business actually in Florida and coming down here, paying, rent or, renting out a place or staying at a hotel. And just something that Molly and I discussed for a while now. Her and I both have been going back and forth on doing this. Coronavirus presented some opportunities where I found a property, unfortunately for this individual from Brazil, his business is there. We're failing, and a lot of people in this area in Orlando near Disney, they from New York, New Jersey, out of the country, had to let a lot of their properties go, and that's the first one you let go, right? Is not your primary, any additional property. So I got in at a really good deal with like 50 baked into the property, a year-old home. But it's something that I've been coming down here and trying to get ready myself to rent out a bit when I'm not here. And then every other month I'm coming down here myself for business and whatnot.
Oh, that's cool. So are you there right now?
Yeah, I'm actually here right now. It's actually not raining in Florida today. So
very cool. Very cool. So I love what you're saying. I think this is a very relevant topic right now. I think with all of the uncertainty in the air, people are looking for safe places to put money, safe things to invest in. And obviously real estate is one of the best things, as we all know. So why don't we just talk a little bit more about financing these second homes, kind of what the different qualifications look like. I'm sure it's a little more complicated than a primary residence, but
Sure.
Let's talk about that a little bit.
Yeah, well, that's excuse me. Actually, the really cool thing about the second home that we're trying to educate all of the realtors we work with and clients that we have, the financing is very similar to a primary residence. Interest rates are identical. The main thing is primary residence for a non-first time home buyer, it's a minimum 5% down payment. Your primary home. For a second home, it's just the minimum is 10%. So it's not a huge kick up from a primary down payment requirement. The cool thing, like I mentioned before, you get the same type of interest rate, which today, for somebody that's got good credit, we're talking 2.5% on a second home. That's really the most attractive thing. Low down payment, great interest rate. It's not the same. If you try to do minimum down payment on an investment property right now is 15%. Even with excellent credit, if you're 15%, you're probably somewhere between 4.5% and 5.5% on your interest rate for an investment property.
So big difference.
Yeah, that's the huge swing on it and what we were looking at, because again, nobody's ever really looking at how long do I have to stay there, whatever. It's a vacation home, right?
Right.
Typically you just have to stay there 1 year. Who gets 6 months out of a year to stay to take vacation? There's no federal requirements on how long you have to be there. But I believe when you look at it, and I'm not an accountant, I think just the minimum is if you claim rent on a second home or vacation home, if you have more than 14 days out of the calendar year, at that point in time, they can't consider it investment. So it really just depends on how you choose to manage the property. But if you're just talking about solely building real estate wealth, getting into a second home in a different place, might be a good way to do that.
So I just want to recap on what you just said there, because I do get that question a lot, is if my client buys a second home, can they rent it out part of the time?
I believe, and again, I'm not a CPA, I believe the last I saw in talking to mine, it was 14 days. If you claim more than 14 days from an IRS standpoint, it is considered investment. You can claim up to 14 days and still write it off, but it's not considered investment. From a lending standpoint, once you purchase the home as a second home, truthfully, there's nothing that tells you in the loan documents you have to maintain this property X amount of days out of the year. That would be a problem. And again, a vacation home, nobody's getting 6 months worth of vacation a year. It's something you might go to for a weekend with the family. It's different than a primary where you're saying, I will occupy this property for 12 months, right?
Makes sense. Yeah, no, makes total sense. And then, so let's talk about a little bit about the lending side. And if you guys have any questions, I see there's about 15 people on with us. If you guys have any questions, just put them down below. We're going to talk again about second home financing and getting into deals as the taking advantage of this market and the extremely low interest rates. So why don't we talk a little bit about like credit score and down payment for these second homes?
Sure. Yeah. So minimum credit score, I was just before coronavirus 580. Right now, we're still sitting at 620 here at Fairway, which is still pretty good. I mean, if somebody falls below 620, we've got tools and systems to run simulators and do rescores to help them get their credit back up. Again, from a down payment standpoint, 10% is the minimum. And that's good enough to get you a low, like for example, on my property, it was $305,000. I think my mortgage insurance, because I just did the minimum down payment, I think it still fell under $100 a month for something in that range, which is minimal. Or you can do a one-time buyout of mortgage insurance. It depends on how the financial situation looks for the individual, how you'd like to structure the loan, but 10% down payment's the minimum. You can still get that same rate.
Rewind just 1 second what you said there about, actually we can get back to that. Finish your point, sorry.
No, that was pretty much it. If you want me to go back to the mortgage insurance.
Yeah, you mentioned a one-time buyout. Talk to me about that.
Sure. So most lenders offer and just sell, monthly mortgage insurance or PMI.
Yep.
PMI's changed over the years. Right now, it actually gets calculated very similar to an interest rate based on the type of property you're buying, the use of the property, the term of the loan, your debt to income ratio, your credit, et cetera, et cetera. What they started offering a couple of years ago, which I don't know why many people don't advertise this or do this, is you can do a single premium buyout. And now that they've changed the calculations of it, if you're well qualified, you might have, I think on my home, for me to choose either like less than $100 a month, or it was like $2,300 as a flat fee, and there's never mortgage insurance on my home. It's not an annual reoccurring fee, it's one and done.
I like that. And is that pretty standard across the board? Do they all offer that, or is that pretty specialized?
I mean, every lender is going to be a bit different, obviously. Fairway with us, we're one of the, I think the third largest lender in the US. So I know we do get premium breaks on what we can offer to our clients the same way as interest rates work and such. So we might have better pricing or premiums than others. But every bank should truly be able to offer that. It's whether the loan officer wants to go through, educate the clients on all of their options and present them to them. That's really the big thing, right? Is our job is to help educate them. They're going to make the decision if you provide them all the information that's going to be best for them. I don't really believe in selling somebody on what I want them to do. It's educate them, inform them, answer their questions, and then let them make the choice for themselves.
Yeah, makes sense. I'm all about it. What about credit score and rates? So it sounds like you're saying rates are a lot lower than investment properties, maybe a little higher than primaries, but let's talk about rates and credit scores.
Sure. So yeah, I mean, credit score minimum 620. Obviously, the rate that you qualify for is going to determine based on your credit one. Being the second home, there's no adjustments to the interest rate, though, for that type of property. Whereas if you have an investment property, it can be anywhere from a 2% margin adjustment on the rate, which puts you really up around, if I just to talk rates, again, 4.5% to 5.5% on a standard investment property interest rate. That's with minimum down payment. Okay. You get to around like a 3% or 3.25% even rate. For investment properties, you have to put minimum 25% down. That's really the big breaking point with Fannie Mae, Freddie Mac on where you start to see, a huge fall off a cliff on where the rates might be. But even sitting there, you're still 0.75% swing from a second home,
Yeah.
And that's really what I think is the best thing about it. If you look at where you want to put your money if you're looking at investing more real estate. And maybe if you want something more long-term, maybe an investment property is the right way if you truly want to have a vacation down the road. But I really, you can kind of do both. I mean, I know with Molly, as an example, I mean, she bought a second home in IB, wanted to have something closer to the beach.
Yep.
And a year later, things change. So now she's turning that into a rental and buying herself, another second home somewhere where she can have a getaway, someplace to escape. Not that San Diego, is a bad place that you want to get away from, but just something to escape, whether it's in San Diego or a different state like, Florida, a lot of affordable properties for people that might not be able to afford a $600,000 second home in California. Arizona's close to a good place where you can find a good destination home. Things like that.
That actually brings up one other question I had. Is there any guidelines or rules around how far away it would have to be from your primary residence?
Yeah, so that's a good question. That's probably one of the more common ones. There's no guideline for majority of them. There's one specific one. If your current primary is financed by FHA, then you could run into some issues where it has to be 100 miles away or such. For most though, there's no guideline specifically. It can technically be in the same city. I've had somebody who had a home in Alpine and even somebody before in La Mesa, and they wanted to buy a property near the beach. It's a little condo. So if it's considered a desirable location, that's different from where you're at. So that's really the thing is, and how you, frame that to the underwriter. Is why is this considered a second home to you? If I live in, let's say, San Francisco City, but I want a home out of the city as well to get away from all of that, you could consider that a second home also. It's really just what it's going to be and how you can paint the picture for the underwriter on why, right?
So really it's just having that letter of explanation that makes it make sense. And it sounds like the only caveat there was if their current primary is an FHA loan, then there might be some.
There might be. FHA has some weird guy. It just depends on how you're doing the purchase, right? I mean, because you could kind of do it the opposite way of what we're talking about, right? You could say, I currently have my primary. I'm going to move into this home. Now my departing primary is now my second home. So you could kind of flip it around a little bit if you wanted to do that as well.
Got it.
FHA thing you'd come into an issue. If you're getting into an FHA financing as a primary, you have to be 100 miles away from a previous departing primary.
Okay. Yeah, no, it makes total sense. Thank you for that. That's a perfect explanation as well. What about credit scores and reserves?
So reserve requirements is something that on a lot of them, they might require 3 to 6 months. It's not a hard set guideline. It really depends on how many properties you own, and the automated underwriting will actually tell you for this individual's file, we require 3, 6, whatever months. If you have multiple properties, obviously that could be greater because the more properties you hold, the more risk adverse you may be, the more, liquid reserves they might want to see you hold for them to feel comfortable lending again on another property.
Okay.
You just for example, you could even, as far as reserves are concerned, if it's just you own a primary, you're buying a second home, it'd probably be something like 3 months at most. Okay. But it would be a healthy thing to say you probably should anyways, regardless if we required it. Right. I mean, you don't want to hold 2 mortgages and, not have enough in the bank should something crazy like we've seen happen this year come up to be able to.
Yeah. Okay. And then credit scores, minimums?
Minimum 620 credit score. Hopefully that up, again, before, all the craziness this year, we were at 580. But 6 is the minimum for the credit scores.
Okay.
And again,
and then, and those obviously fluctuate up and down depending on how tight and uncertain things are. What about things like the DTI, the debt to income ratio, and on the payments? Where do those need to fall?
DTI, the maximum they'll allow is 50%. Okay. So mean that everybody can get 50%. It's just the maximum that Fannie Mae, Freddie Mac will allow you to go to. One thing with that caveat, though, is mortgage insurance companies do take into account your DTI as one of their qualifications in how they issue your premium for your mortgage insurance. So if you go, like, say, 43%, some of the mortgage insurance companies might double the premium on what you have to pay monthly or pay out as a one-time fee. So
got it.
It's one of those things when we look at the credit, even if somebody's got qualifying credit, we try to run through those simulations with them to say, hey, listen, even if we can qualify now, can we get better? How can we help put you in the best position to close on this loan? I would think one thing that I don't know if we'll get to with Molly's questions, one thing I wanted to bring up that people may not know, there's still a lot of people that rent. You can be renting a home and buy a second home. You don't have to own a primary to own a second home. And I'm not sure if people fully understand that you can do that. Your primary is wherever you live, not what you own. Home can be a property. Like for me, I mean, I sold my home several years ago. I don't own my home currently in San Diego. That'll come in the next year. But the opportunity for me to get something that I had a great opportunity on, like I mentioned before. So I ended up buying a second home before I bought my new primary in San Diego.
Yeah, makes sense. No, that's actually a good tip because I wasn't really aware of that either. So, and then that obviously just factors into the DTI as long as you're under 50 on both, then it's all good.
Yeah, essentially. And I mean, even down the road, if they choose to rent it out eventually, well, then they can use that as qualifying income down the road to buy another property. If after a year or 6 months, you'd say, hey, I'm going to rent this thing out, or circumstances change, life happens, right?
Right.
Then you might have qualifying income for another home.
And in order, just to put a pretty bow on that, in order for it to be qualifying income for another home, does it have to be rented for 2 years, or what's the guideline on that?
If it's for a second home, they may require that. The thing is, if it's departing residence, you typically can say, well, I'm leaving it. It will be rented, and either get a lease agreement or a comparable rent schedule, evaluation of rent by an appraiser. It really just depends. If you've got a lease agreement signed for 12 months, they'll probably consider it. But for those who might not be able to afford to buy in San Diego right now, but want to get invested in real estate, I mean, it's a good opportunity where you might be able to buy something affordable. It might not be San Diego, and I know you guys are looking to expand into other places. But I mean, what if, I don't know what Bakersfield costs to live or some of the other areas. If you live in San Diego, maybe you find something in Temecula that, hey, I can go there on the weekends. It's wine country. You can definitely use that as a very sound reasoning to have a vacation home. But maybe I can have a weekend, or Big Bear, if Big Bear is, depending on what you can find there, it's affordable now.
Right.
But like that. I mean, if Arizona, Florida, there's a number of places you can look to go to if you want to get invested in real estate, but just can't afford California right now or San Diego.
Yeah, which is a great tip. I mean, I own a couple properties in Arizona myself, and highly recommend, as long as you have a good team and a good property manager, going out of state for stuff like that. On the second home side, obviously that might even be a little easier because, you just get yourself maybe in Havasu or whatever, somewhere that you like to go. Vegas, Florida, like you were saying, has a lot cheaper real estate and makes it a lot easier to get into.
Maybe get some Big Block agents here in Florida.
Is there anything else we want to wrap a pretty little bow on? Sorry, my computer's dying, so I got to plug in.
Not a problem. I mean, I really just think it's what you're looking at to do for your clients. Everybody, I think, has a chance to invest in real estate, and there are certain, opportunities that come around. I've done this for 16 years. I know you guys have been in this for a while. You get certain opportunities that come by you, and not to say that rates won't be low for a while moving forward. Who knows when they'll start to go back up, what will happen moving forward. But if you have, in my opinion, if you have an opportunity to get in at something at 2.5% with minimum down payment, I think it's whether it's in California or you need to look for your clients outside of there. Again, it's just a good way to help people build their wealth, build your own wealth, even if it's not for your clients. If it's start looking into. Like you said, you have Arizona. I mean, certain places you can buy something here in Orlando in nice areas, $250 and less with a pool, and you're right by Disney. So if you ever just rent it out, eventually people will start going back and being out more publicly again. And, Disney's one of those places that people will always go to.
Yeah. No, I love it. I think you're totally right. I also love the tip you gave about even if someone's renting their current residence, because we all have friends, right? And clients that might be renting right now, but if you presented this as an option, like, hey, let's get you, to your point, let's go to maybe somewhere a little further inland where prices are lower. Let's get you into some real estate, and then that gets them going down the path of becoming a lifelong client, and you help them with something that they might not have known was even an option.
They could be renting in Point Loma and buying Ramona, right? I mean, you really help somebody, even, like I said, it doesn't have to be out of state, but locally. There are pockets in and around San Diego, Riverside, and you guys got offices up north too, that you might be able to help that client find a home that they can get into having wealth in real estate, which is huge. I mean, we all know the best long-term investment is always real estate.
Yeah, definitely. So again, if you guys have any other questions, I've had his info on the screen, but give him a call, 858-251-3712, or jason.cota@fairwaymc, like mortgagecompany.com. One last just kind of side question I had was, because you brought up rates, and we talked a little bit about PMI, and this is something I've talked to a couple people about, and they say, is it better for me to save up 20% and get into a loan without PMI, or am I better getting in now and paying the PMI? And with that strategy you brought up of maybe just paying the PMI up front, that might be the best scenario. But because if you do take a loan with PMI and then you got to refinance your loan in a couple of years, like, are the rates still going to be low? So I just wanted to kind of get your thoughts on that.
Yeah, I mean, I think my first initial thought is there's never going to be the perfect scenario to buy. So if you're in a position where you've got a healthy market, you've got low interest rates, and you can afford the payment on that home, I don't think you miss out on an opportunity like we have right now, because it's going to be a 30% less home with the same monthly mortgage payment if you wait maybe another, a year, 16 months, and then that opportunity's passed you by. So that's my first initial thought. I wouldn't wait for that. Just like the same individual, like, I'm going to wait till all of my debts are paid off completely. Now I'll go buy a home, right? Nothing's ever going to be perfect. Whether it's monthly PMI or single premium, as they call it, PMI, you can also, if you put down enough, you can finance PMI. This is something people don't know as well. We didn't get a chance to get into it earlier. You have to put down, you can never finance PMI to go above the minimum requirement, right? So if the minimum or the most you have to put down, minimum you have to put down is 10%, you can never finance above that 90% threshold, right? So what if your PMI, though, in a percentage was only 1 or 2%?
Mm-hmm.
Now, if you put down 12% and finance the PMI, you're still meeting that 10% minimum requirement and not crossing that threshold. And you're stretching like $4,000 or $5,000 over 30 years. That's a third. Yeah. So
that's good. I like that.
Kind of change. I mean, the one-time buyout, the monthly is a tough one, because you're right. I think that's the one where people need to start getting creative, especially when you have a rate environment like this, because for it to fall off, it typically has to be a minimum of 7 years, and you have to reach, of the initial purchase price, 20 to 22% of the initial purchase price. They do not take appreciation into account when MI is going to fall off. So that could be, some time. And do you want to wait to refinance out of it just because you don't want to go that full term before you get to that equity threshold? Now you've lost your 2.5% rate. The savings probably aren't there anymore. You might as well write it out.
Right.
So I think that's where, working with the right people and getting creative to present those options, you can always find a way to get something done that I think can benefit the client in a manner that long-term can help them better than the short.
Yeah, and realistically, if that is a concern, they should just do what you said and pay it up front. Because if you can buy out the whole policy for $2,500 or something,
right,
then that might be your best bet. Put your down payment, buy out the PMI, and then get a long-term loan on the property, and just.
If you don't have a lot of reserves, again, don't do the buyout, finance it. Put the extra money towards down payment. Paying the full premium. It's just enough to get you to where that finance premium doesn't cross that 90% threshold for you, and then stretch that over 30 years. I mean, most people, you're not going to notice 5,000, even if, let's say, you have poor credit, so the premium's higher. What is $10,000 stretched out over 30 years to your monthly mortgage payment compared to what your monthly PMI would be with poor credit? $300-400 over 8 to 10 years, right? It just doesn't make sense to do it that way.
Yeah, that's a great tip, man. That's a really good strategy. I like that.
Yeah. So
that, I feel like we covered pretty much everything on the second home stuff. Is there anything else you want to add before we wrap up today?
Just that, again, you guys got a bunch of great agents there. I mean, start looking at who your past clients are. Who has, if they need to access equity in their existing homes, they're not looking to move up or move down. Buying a second home might be something they want to look at. It's not a lot. I've talked to many people this year, and if they're not buying investment properties, they're looking ways to get better financing, and a second home could be a great way to do that. So.
Makes total sense. Again, Jason Cota, Fairway Mortgage. Really appreciate you coming on today. I think you've given a ton of value. Again, give him a call if you guys have any questions on this stuff. He's really a wizard, really knows his stuff, and he can help you and your clients structure deals in ways that maybe you and they haven't thought of. So definitely recommend giving him a call, shooting him an email, picking his brain on this stuff. He's really a library of information on the lending side, and appreciate it, man. Thanks a lot.
Hey, thanks for having me.